But what was his influence? Well, let's go back in time to 1973. He advocated for investing in the broad market rather than small number of individual stocks. Now, his book really introduced all kinds of concepts about investing in individual stocks or in the market. But at that time, there was no index fund or passive investing. And so he was the first one that was really advocating. He wasn't the first one to come up with the idea. But it's interesting that the king of the markets, Warren Buffett, in 1974, the next year, had its worst year ever for Berkshire Hathaway, which I was just getting from this book of the letters of Warren Buffett that he wrote to shareholders. But that was down 49%, twice as bad as the S&P's fall of 26%. So I'm trying to put it into context what was going on at the time. Now, in 1974, John Bogle founded the Vanguard Group, and there he is around that time. In 1976, so that's John Bogle, Vanguard introduced the first publicly available index mutual fund known as the Vanguard 500 Index Fund. So they were adopting what Malkiel was advocating. Now, Bogle had already had this idea himself, so it wasn't like Malkiel suggested it to him, but they actually worked together from 1977 to 1999 when Malkiel was on the board of directors of the Vanguard Group. What's interesting about Malkiel's influence is, as I said, from zero to hero. This chart produced by Yahoo Finance goes back to 1993 when passive index funds were zero. Basically, nobody had money in them. So even though they were started many years ago, even by the early 90s, they still didn't take off. But the quote from this article says, as of March 31st, 2022, Morningstar says retail investors had $8.53 trillion invested in index mutual funds, while $8.34 trillion worth of assets were invested in actively managed mutual funds. That's quite an impact. Basically, the whole passive fund revolution came from Malkiel's advocacy, but more importantly from Vanguard and Bogle. But they were tied at the hip. So here's your cheat sheet. We're going to go over the first section of this. But I want to warn you that I have brought a huge amount of my interpretation of things, latest data, analysis in this. So we're going to go, although we're going to go outside of what's in the book, all the material that I'm presenting is what is presented in the book, but I'm going to explain it and update it and go through it in more detail. Also have your quote sheet there you can get. So let's just look inside the book. The book is broken into 4 parts. And I decided not to break my presentation into 4 parts. I've only got it into 3 parts. So let's look at those 4 parts for a second. Stocks, talking about that. And then how pros play the biggest game in town. And he's introducing the efficient market hypothesis, which we're going to talk about. And then new investment technology. Now, he wrote that many, many years ago. The latest one, obviously, as you can see on section 11, has ESG. That wasn't around in 1973. So let's talk about understanding investing theories that he presents. He calls it the firm foundation theory, which states that companies hold inherent worth. There is some value that you can calculate of a company, and that value is determined by the current and future cash flows of the business. Now, Warren Buffett used this theory, of course, to build Berkshire Hathaway. But there's another theory, which is the castles in the sky theory, which states that companies hold psychological value. So this theory is determined by others' perceptions and can also be called irrational exuberance. And that's occurred in the past where the value of stocks deviates massively from what you could say is a firm foundation. This teaches that the price movements of stocks can guide buy or sell decisions. And of course, it assumes that news affects stock prices and the stocks follow trends. So the castles in the sky or in the air is a theory which is also called the greater fool theory. Now, there's been many financial bubbles that he highlights in the book, and I decided I would show some charts of what he goes through on these. And so first, he looked at the British South Sea company price and the bubble that it went up to, and it was, of course, massive. And he looked at the Japanese stock market bubble, which really peaked in late 80s.